The challenge of aligning investment for net zero is a big one and not an easy one. In this presentation, Natasha Landell-Mills and Ben McEwen of Saracen and Partners explore what investing for net zero looks like in practice and how it can be encouraged. Where is investment needed most? How can opportunities be identified? And can shareholders drive change?
Good afternoon, everyone. Natasha and I are very pleased to be able to present, albeit virtually, some thoughts on climate change from an investor's perspective with you today. My name is Ben McEwen, Climate Change Investment Analyst at Saracen and Partners, and you'll also have the pleasure of hearing from my colleague, Natasha Landell-Mills, Head of Stewardship at Saracen and Partners. The title of our presentation to you today is Achieving Net Zero, How to Invest and Press to Drive Climate Action. We believe that these two elements, invest and press, are substantive vectors for asset management to pursue. In doing so, we believe that investors can generate returns for our clients, whilst also help driving climate action, such that the goals of the Paris Climate Accord are fulfilled. As such, we believe that asset managers can play a positive catalytic role with regards to climate change. I will start off by running through the invest dimension, which considers both the investment opportunities a net zero economy presents, and also how one might integrate the investment risks from climate-related transition and adaptation factors. I will then pass over to Natasha, who will cover the press dimension, that is, how investors can drive change through engagement and policy action. While we have separated these factors, we believe it is important to note that invest and press are not distinct considerations. We very much believe that an approach that integrates both factors is likely to deliver the most tangible outcomes. I think it would be remiss of us not to start out with acknowledging the scale and the severity of the climate crisis. The sentiment that climate change was a problem for future generations to address, or indeed different industries apart from the asset management industry to address, is evidently changing as the physical manifestations of climate change become ever more apparent. The map we show here indicates the global land and ocean surface temperature, and that it was the second highest in the 141-year record at 1.03 degrees centigrade above the 20th century average. This temperature deviation has been accompanied by significant depletion in Arctic and Antarctic ice levels, drought conditions across much of the US, and extreme precipitation across swathes of Asia. Of course, with rising emissions, so follows a rising concentration of CO2 in the atmosphere, and thus an increase in global warming. This chart shows that under baseline scenarios, current policy projection scenarios, and even pledges and target scenarios, global warming levels are likely to be well above the well below 2 degrees outcome that the Paris Climate Accord calls for. This will result in significantly more profound physical manifestations of climate change than we've experienced today. In order to meet this lower temperature outcome of the Paris Climate Accord, we therefore have to bend the global emissions curves towards zero. This is shown in the green line scenarios and indicate that the sooner we get started in reducing emissions, the easier it will be to achieve this net zero target. So what do these scenarios imply for the investment industry? As supported by bodies such as the IPCC, we believe that climate-related capital expenditure will have to rise significantly. Global climate-related capital expenditure has grown at a compound annual growth rate of 8% over the last 5 years and stands at between $600 to $700 billion annually. To achieve net zero outcomes, we will likely have to grow this capital allocation to in excess of $2.5 trillion annually, implying a compound annual growth rate of 28% if this is achieved by 2025. For reference, the quantum of this climate-related capital is equivalent to the current capital expenditure shown of all the industries shown on the left-hand side of the chart. This climate-related capital will need to be sustained annually and will need to be directed towards a variety of mitigation avenues, including energy efficiency, renewables, nuclear and carbon capture storage, electricity transmission and distribution, and storage. We therefore believe that climate change offers a significant and growing opportunity for investors to deploy capital towards. At Saracen & Partners, where we use a thematic approach to identifying opportunities, climate change is one of our 5 mega themes, and here we show the underlying climate change sub-themes. These sub-themes are divided into both mitigation and adaptation opportunities, though mitigation spans all 5 of the sub-themes. As mentioned at the beginning of the presentation, climate-related investment risk is another dimension of the invest pillar. Here we show an excerpt from the Sustainability Accounting Standards Board, or SASB materiality map. It shows the level of materiality and thus risk associated with both greenhouse gas emissions and physical impacts of climate change for a spectrum of industries. We believe that while this top-down approach to identifying climate-related investment risk is of considerable importance, investors cannot rely on such frameworks and must engage in bottom-up risk analysis. This is because both transition and adaptation risks are highly idiosyncratic to individual firms. So we've shown a top-down approach which we believe underlines the significant opportunity and risks that are associated with climate change and the transition to net zero. How then do we translate these top-down approaches into investment outcomes? Here we show the process we undergo at Saracen & Partners to integrate these into our decisions and actions. Firstly, we consider assets as individual and consider both quantitative inputs, such as scopes 1 to 3 emissions, as well as qualitative factors around the challenges companies face in achieving decarbonisation objectives. We then assess the nature of specific physical and transition risks and how these might impact financial factors such as revenues and cost of capital. This allows us to generate a risk analysis score and what we have termed climate value at risk, which I'll come to shortly. These outputs then frame our investment conviction, as well as informing our voting and engagement efforts. If we turn to our climate value at risk in more detail, we believe this methodology allows us to better translate risks and opportunities from net zero into investment perspectives. Here we apply climate scenarios, such as net zero outcomes, and apply changes to our investment models. These changes are not homogeneous and may include changes in the pricing of goods, such as fossil fuel prices, or the impact of carbon prices that are aligned with net zero outcomes on emissions-intensive sectors. We're then able to generate net zero or climate scenario value of a given asset and compare this to our base case value. As shown with company A on this chart, this allows us to identify instruments that have a potential valuation downside from these net zero scenarios. The converse is true, as shown with company C, where we believe that capital markets are significantly underestimating the value of an instrument given net zero trajectories. Of course, these instrument level scenarios must be incorporated into portfolio level outcomes if we're to invest and achieve net zero. Here we show an example of a portfolio that has transitioned its holdings away from those with climate risk, marked in purple, towards those that are set to benefit from a net zero outcome, marked in green. We believe this shift in capital allocation both reduces risk and is likely to generate improved returns. Critically, over the course of 2020, when we run statistical correlations analyzing performance, we do find an increasing correlation between climate value at risk scores and instrument performance. We believe this is evidence of a nascent capital markets pricing of climate change factors. A final slide to summarize before handing over to Natasha. We suggest that a combination of top-down climate change factors combined with bottom-up analysis that integrates climate scenarios can generate investment opportunities and mitigate risks for our clients, while simultaneously directing capital towards the adaptation and mitigation solutions we need to transition to net zero. The summarized baskets that this process generates are shown on this slide. Those with positive exposure, with companies best placed to benefit from mitigation and adaptation opportunities, those with neutral exposure, where we believe there to be limited materiality of climate change, and finally, those where we've identified heightened vulnerability to climate-related issues. This is only half the journey and half the responsibility of asset managers. So with this, I'd be pleased to pass over to my colleague Natasha to cover the press dimension.
Thank you, Ben. As Ben has said, investors can undertake some very detailed analysis for us to be able to understand climate risk and integrate that into our investment decision making. The question then is, how can we also use that information to engage with companies to press for action on the ground? I'd like to spend the next 15 minutes or so just explaining to you how we think about this. Firstly, let me kick off with a framework. In the end, what matters is capital allocation. Now, as we've been hearing from Ben, investors can take account of climate risk and integrate that into how we choose the companies in which we deploy capital. But then companies also deploy capital on the ground, and investors as owners in those businesses have a voice, and they can press those companies and the leadership to make sure that capital is deployed on the ground in a way which is consistent with Paris. So why bother with engagement? Why not just focus on investing in more sustainable businesses? Well, the main reason is that many existing fossil fuel companies continue to deploy vast amounts of capital into fossil fuels. And this chart here on the left demonstrates that very nicely. Even in 2018, where fossil fuel investment has come down a bit, it's still far greater than capital that's going into cleaner energy. So we need to be pressing those fossil fuel-based companies to ensure that they're not investing so much into activities that puts our planet at risk. Another reason to engage with companies is that even where you sell the shares, they may be getting finance from elsewhere. This research from the Rainforest Action Network and others, which was recently updated this year, demonstrate the scale of that finance is coming from global banks. In this case, it's 35 global banks going into fossil fuel-based activities. 2.7 trillion has been going into these activities since the Paris Climate Agreement was signed, and it's continuing to increase. So we need to be pressing companies, not just by selling their shares, but by saying, please don't borrow more money or don't use the money that you're generating as profits to reinvest into fossil fuels. A third reason that engagement matters is that we need to be pressing these companies to be lobbying in a way which is consistent with Paris. Unfortunately, the evidence suggests that many, if not most, of the fossil fuel-based companies today continue to lobby against more robust action on climate change. This data in front of you comes from Influence Map. And what they've done is recently been tracking lobbying data points from these different sectors against action on climate change. And that lobbying, the number of lobbying activities against climate change far outweighs any more positive lobbying in favor of action, which is the bar on the right. This needs to change. So even if we want to engage, how do we make sure that we have an impact? Every asset manager will differ, and also every case will differ, but this schematic gives you a broad sense of the steps that are involved. The key thing is that we're results oriented and that we have a plan. The first step is to identify which companies to focus on. Engagement is very resource intensive and you can't do everyone. So you need to pick those companies where you're going to have the biggest impact. Then you need to draw up an engagement plan with a goal and activities and milestones and a timeline. Invariably, the first step is to write a letter, what we call our Paris alignment letter, to the chair or the lead independent director, and to ensure that voting is aligned with that engagement. Now, in many cases, that's enough, and we reaffirm our conviction in that investment. But quite often you need to escalate, and there are a number of things that one can do, from coalition building with other investors, to escalating your voting, to AGM actions such as filing a shareholder resolution, media outreach, and even regulatory complaints. We will use all these tools. And ultimately, the idea is to have that impact. you might require several rounds of escalation before you have that impact, and it can take time. It can take, in our process, we allow up to 3 years to have that impact before we take a decision as to whether to sell. So that's the theory. Let me just take you through a recent example of an engagement that we led with BP. Now, clearly, this engagement lasted a long period of time, and our focus here was getting BP to commit to a net zero strategy as well as deliver Paris-aligned accounts, something I'll come on to. There were a number of steps, from filing a shareholder resolution in 2015 to further engagements through 2016 and 2017, letters to the chair, such as our letter in February 2018 asking for the directors to commit to Paris, further voting action, as well as actually asking a public question at the AGM, further letters to the chair. As our engagement progressed, we focused more and more on a key lever, which is ensuring the accounts were aligned with Paris. Again, I will come on to explaining this important point. And we escalated again our voting in the more recent AGM. Our most recent escalation was in November 2019, where we convened a broader group of investors of around 1 trillion in assets under management to write again to the chair, as well as the audit committee chair, to say the accounts that the company were producing needed to be aligned with Paris. And we started to have an impact. In the annual report that was published just this spring, they set out how they were considering Paris in drawing up those accounts, and the auditor pointed out that they needed to go further. And then that triggered, in our view, an announcement this spring, which many of you may have heard of, where they decided that they would go further and fully align their accounts with Paris, which led to very considerable estimated write-downs of up to 7 billion, as well as then leading, in our view, again, to them publishing a much more robust net zero strategy. But success in one company, whilst great, is not enough. In the end, we need the whole system to change. And what our engagement with BP told us was that to change the system, every company needs to produce what we call Paris-aligned accounts, so that the numbers take account of getting on to a net zero pathway and are not drawn up based on missing that target. Accounts act a bit like an altimeter for a pilot. They gauge the capital level as well as performance, and they tell the executives whether that entity is going to crash. And despite that importance, they're often overlooked. They're an absolutely key lever within the financial system. They drive decision-making, and they give executives as well as shareholders a sense of where capital needs to be deployed. When climate risks are left out, that means ultimately you're going to have too much investment into activities that harm climate, too little into activities that protect climate, and that will lead to risks both to the company as well as, of course, to our planet. Let me illustrate why Paris-aligned accounts are so important to shifting our system onto a net zero pathway. I've got a hypothetical coal-fired power station in front of you, and I drew out the key elements of their accounts. Now, in this case, they ignore decarbonisation. They presume there's no such thing as a Paris Climate Accord, or at least that it won't be implemented. So in that case, their assets will be valuable for many, many years, and they depreciate those assets over, let's say, 30 to 50 years, because there's no sense in which they're going to have to shut down earlier. That means that the depreciation charge every year is lower and their profits are higher. They also assume rising demand into the future with GDP, as they always have, which underpins the value of those assets on their balance sheet. No impairments. Finally, when it comes to asset retirement obligations, the sort of cleanup costs that come when the assets are shut down, well, those are now distant in the future and don't have a particularly big impact on their liabilities today. Overall, we see a business with higher profits and higher capital, and therefore you will see more reinvesting going into coal-fired power. Now, let's take the example where we actually assume Paris is implemented and coal is being phased out. In this case, the asset life is much shorter, and therefore the depreciation costs every year will be higher and profits lower. Likewise, those assets, because you won't see the same level of cash flows going into the future, will probably need to be written down on the balance sheet. Finally, the asset retirement obligations will be brought forward. They'll have to do the cleanup sooner, which means the cost or the provision that they are required to put aside is higher, again, reducing profits. So this business now is much less profitable. In fact, it may not be profitable at all, and you will not see reinvestment going into coal-fired power. Thus, such is the power of the accounting. So this presentation is about how we ensure we get onto a Paris-aligned trajectory, and Ben has highlighted the investment side. I've emphasized the pressing side, the pressure on companies to change. Ultimately, what we require above all is a shareholder awakening, if not a shareholder revolution. Incremental steps will not get us to net zero. And the role of finance in that is absolutely vital. In essence, the purpose of finance is to allocate capital to activities that deliver the greatest societal benefit. So thought about that way, the role of asset managers is also key. And as we've said, we play a role at two levels, both in the way we're deploying capital, investing, but also in how we're acting as stewards to press companies to themselves deploy capital in a way which benefits society. To act contrary to this would be focusing on short-term cash returns in a way that harms our environment or society, which is neither sustainable or desirable, as is so nicely summed up by this cartoon. Thank you.